Last week's video was all about risk, knowing what you own, knowing that the stock market could get a lot worse than it is right now. And I was kind of cuddly about it because I'd had a few messages from people whose stocks had gone down and they were worried that they were going to continue to lose money. But this week is different. No more Mr. Nice Briscoe, because the FCA and a research firm think they have you pegged. They think that everybody that's watching this YouTube channel can be categorized as 3 types of investors.
I'm amazed how many people own stocks. I'm amazed how many people own stocks.
Welcome back everyone, my name's Paul and I'm a self-directed investor. I'd never heard this term before I'd read this research article, but it seems that now we're no longer called retail investors, dumb money or DIY investors, we're officially called self-directed investors. And today I want to take you through the highlights of this research paper to show you exactly what the FCA and this consultancy firm think of you. And it's been a nice month for dividends, so I'd love to take you through a quick look at my dividend growth over the month of April. So this is a new paper that's been commissioned by the FCA called Understanding Self-Directed Investors. It's been put out there because the FCA thinks that we as self-directed investors don't know what we're doing. The FCA seems to want to clamp down on crypto, commission-free apps, those sorts of things, because there's too many people getting into them and those people aren't understanding the risks that they're taking by getting into high-risk, high-return investments. It's full of amazing insights like this graph which shows older people have been investing longer. I have no idea why they needed to put this in, but essentially the Financial Conduct Authority has already made up its mind that you don't know what you're doing, and this research is designed to figure out who we are and what we do and where we like to stare all the time, so the FCA can get some new messages about risk into our little eyeballs. It's not necessarily a bad thing for them to put more warnings on stuff, put more advertisement out there to make sure that you do start to understand the risks that you're taking when getting into investments, particularly high level, high risk, high return investments. But this paper does highlight investment apps such as Trading 212, Free Trade, Crowdcube, and these apps are now being accused of drawing you in and making you take more risk. I'm not entirely sure that is true. It's one thing to inform people of risk, and arguably it's actually okay to annoyingly inform people of risk as well. But if they're thinking of clamping down on investment brokers themselves, I do think that's a bit of a problem. Because while these apps have allowed new self-directed investors to get into higher risk and higher return stocks and investments, they've also allowed new investors to get into higher stocks and higher return investments. Sites like Trading 212 have opened the door to me to get into investing and allowed me to start thinking about my money in a different way. I'm not entirely sure I'd still be investing as diligently as I am right now if it wasn't for low-cost trading apps like Trading 212. And this paper doesn't seem to include normal equities like stocks. It actually seems to completely disregard them as anywhere near high risk. And even I would put individual stocks and even index funds in as quite high risk investments. But this paper is targeting crowdfunding, peer-to-peer lending, FX, high yield or junk bonds, land banking, which I had to Google. I didn't think there were that many people invested for less than 3 years who were just buying land as storage. That one was a new one for me. But also 2 of the massive ones like cryptocurrencies and CFDs also feature quite highly. But they don't feature much more highly than crowdfunding or peer-to-peer lending, which was quite a surprise to me. And probably the most damning result that they did find is that nearly 50% of people that they interviewed, I think they interviewed about 500 people in the end, 50% of those didn't think that they were going to lose money by being in investments. They found that 28% of adults have actually started thinking about their finances since lockdowns. And this is generally because of that disposable income that they've seen because they've been in lockdown and they haven't been going on holiday and stuff. So really there's been nowhere else to put it. I really think that that is going to be such a marker for a downturn. Everyone's just going to start taking their money out of investments when the world opens up. And according to this paper, there seems to be no one in this world who can understand self-directed investing. We all need to have our hands held by a competent financial advisor. And to be fair, there's no reason why you shouldn't do that. If you wanted the easy life and you wanted to go out and just forget about your money, let an FI do it. There's no problem with that at all. If you don't feel like you've got a basic knowledge and don't have the confidence to manage your own risk, then yes, go to a financial advisor. It makes so much sense. Just be aware that they're going to take a lot of fees off you. It even mentions that thought in this research, but it fails to mention that most financial advisors and hedge funds and institutional investors fail to provide any significant returns anyway, and you're better being in index funds. And it gets a little bit condescending and, to be fair, a little bit sexist and maybe even racist once you start delving into the profiles that they've created for everybody. Like the having a go personality. Poor little Rebecca has been sitting in her apartment through lockdown. She's a little bit lonely and she wants to make some money. She's basically got two options. She can download Trading 212 and try getting into Tesla, or she can download OnlyFans and flash a nana around the world. Nana. But she's decided to sit at home and watch idiots on YouTube tell her about what their latest hot stocks are. This doesn't take into account that some YouTubers out there are absolutely phenomenal. They know a lot about investing, and if they're going into new innovative style stocks, there's a lot of really good information out there. There's real engineers out there that can tell you everything about Tesla. You've got Kathy Wood, who can tell you, she's on YouTube all the time. She knows that that is one of the best ways to get to new investors, and she's pretty smart, right? You've also got 31-year-old Tarek, who's known as the Gambler. He's into CFDs, he's into FX, he's looking for volatility and buying the dip. Tarek's mainly using gut instinct to tell whether a stock's going up and down, which, yeah, that doesn't generally work. But what's important is he's using money that doesn't go towards his finances. He's using that spare money for fun, apparently. And I guess each to their own. If you want to speculate and gamble, but you're not taking any risk with your real finances, you're not cutting into your mortgage or nothing for it, then I guess just go for it. And I guess for this type of person, there's already quite a lot of warnings out there to warn you about the dangers of CFD and Forex trading. And then you've got the guy who's thinking it through. He's late 40s, early 50s. He's in the oil industry. He has a little bit of financial background, so he really knows what he's doing, and he's exceptionally confident in that. That's one personality I do see in the YouTube comments a lot. I see a lot of people who are very, very confident in their ability to pick stocks, and nothing can turn them away. Nothing can persuade them that they might possibly be taking a risk. And I guess the danger of being in this category is that if you are this type of person, you probably don't think you are in the category. You probably think you're different and better than everybody else, which statistically is very unlikely. And I found this really hard to deal with at first, that 50% of the people out there think that they can't lose money in the stock market, or at least if their investments went down, they wouldn't be financially impacted. But they only talked to about 500 people. So I thought, why don't I ask some questions? And thank you so much to everybody who's been putting up with all the weird questions I've been putting out there on the community tab. There has been a significant amount of interest in these polls, with some of them getting more than 2,000 votes. This is a pretty good sample size. And I'm guessing you who's watching this YouTube video and engaging with these polls are the sort of person that they're talking about. So to find that 17% of people who are watching this channel would actually financially struggle if their investments went to zero is quite troubling. It's not 50%. Let's get that straight. It's not as bad as what Britain thinks stinks. But 17% who are openly admitting that they could have some real problems if their stocks went to zero is a problem. And I'm not saying that you wouldn't be financially impacted. If my stocks went to zero, then I'd be upset, but I wouldn't have to change my monthly expenses. I wouldn't have to invest more into the market to try and get that back. I would simply continue to invest in the market and just accept that I lost that money. The survey also found that most people don't get their information from reputable sources. They get it from Facebook, Reddit, and TikTok, and YouTube. That is kind of worrying, but YouTube in particular is a new place to store knowledge. I know full well that our personalities are just an equation based on our past experiences and what people around us are saying. So your investments are also very likely to be influenced by your peers and other people around you, and opinion pieces like on YouTube. But that's never been any different. People used to find out their investment tips from the paper or down the pub. So that's not relevant unless they're trying to figure out where to put their adverts so they can get them into your eyeballs. That makes sense. 50% of viewers are renting or living with parents. Now, this is an interesting one because 10% of everyone is investing to save for a mortgage deposit. This is very similar to what the study found, and they make the assumptions that people who are either renting or in early mortgage or investing to save a mortgage do not understand the risk that they're taking, and their futures will be financially crippled if the stock market takes a crash. I have to agree with that there. Investing to save for a mortgage deposit is not a smart move if you're going to need that mortgage deposit in the next 3, 4, 5 years. No one has the capability of predicting where the market's going to be. Hats off to that 7% that have paid off their mortgage though. You guys must be living the dream. And these last two questions haven't had as many votes because I literally put them out 2 hours ago, but they're starting to show the pattern that I was thinking was going to come up. And it's that most people here that are viewing these videos do understand that they're taking a risk. Scores of 3, 4, 5 when they're getting into the high growth stocks. It's very nice to know that people are taking the risk. But this final one is quite worrying. The study found that 41% of the 500 people that they interviewed did not think that they would lose some money. And I asked the question, do you think there is a realistic chance of you losing money with your stock picks? And 23% of people said no, that they're not going to lose any money, or there isn't a realistic chance of them losing money in the stock market. Is this real? Have I asked this question wrong? 23% of 424 people think that there isn't a chance of them losing money with their stock picks. If that's a true reflection of people that are just in stocks, then yeah, maybe people in CFDs and peer-to-peer lending and things really don't understand what they're getting into. So yeah, while this research does show that a lot of investors don't really know what they're getting into when they're getting into high-risk investments, it also says that people under 60 and people without a financial advisor have absolutely no idea what they're doing. It's really hard to justify that I'm not one of these personalities. I definitely fit a lot of these traits personally. But also being over 60 and not having a financial advisor isn't necessarily the best way to long-term wealth. Let me know what category you think you're in. Are you a bit like Paul? Have you got a bit of a financial background? Have you been investing a long time and you kind of really know what you're doing and no one can really tell you any different? Or are you like Bimbo Becky, who can't think for herself and only gets her investment advice from YouTube videos? And apparently Warren Buffett likes cryptocurrencies, so she's invested in them. Seriously, some of the accuracy in this report is really off. Or are you like Tarek the Gambler, who's been going off gut instincts, he's been buying dips, he's trying to trade on those swing trades, but you're doing it more for fun and you're going to stave off that crippling addiction that's going to affect your housing and jobs and family for the rest of your life. There is a lot more to this research paper. It's quite insightful. If you wanted to get a hold of that one, we've put it in the resources room on the Discord, or you can Google Britain Thinks and get it off their website. I'm just very surprised that they created that sexist have a go Becky profile when, the overwhelming majority of their workforce are women. The way they've laid out that report is very condescending to me, but to be fair, I think they have uncovered a few points where people genuinely don't understand the risks that they're taking when getting into investing. Okay, my portfolio is currently sitting at 26,003. This is a dividend reinvestment portfolio. It's designed to get me a bit of income. Nothing about my choosing is about the dividend specifically itself or the dividend yield. I just know I'm very new to investing, so I've decided to kind of narrow my search terms. The majority of very good businesses out there all pay some sort of dividend and they all have a positive cash flow. From what I've learned with investing over the past year or so, the most important thing to investing, the most important thing to individual stocks is cash flow. Are these companies generating high cash and are they able to generate that return and give it back to the shareholders? These dividends that I'm paid, these little bits of the pie that come out of these companies, I get to reinvest them back into either the same company or individual companies that I think are particularly undervalued at the moment. And eventually, if I let that continue to compound forward over the many, many years, eventually I'll have quite a nice little retirement pot. And my compounding is still extremely new. I've literally been doing this a year, but this month what I am seeing is a definite sign that this really works. In April last year, I received £11.54 in dividends. And this month, in April 2021, I've been saving and adding and then reinvesting those dividends as well. Although, you've got to remember at this stage, reinvesting the dividends isn't really making that much of an effect. When I'm starting out, I've really got to save quite aggressively to start making any real money. And that's what I've been doing. And in April 2021, I've now made £79.55 just in 1 month. Just in the month of April, companies from all over the world have paid me money to store my wealth with them. And £79 feels like a really significant return. We're now getting into really buying new shares. And hopefully as time goes on, this will really increase. And next year in April 2022, this should be significantly higher. I'd like to think that this will grow exponentially as the years go on. So maybe one day if I continue saving a lot, I could have £500 a month, £1,000 a month. Really £1,000 a month, that's where I'd be getting to the point where I could say, you know what? I might not need to save anymore. This is just how I'm doing it. It's not necessarily the best way to invest. There will be lots of people with other opinions on the best way to invest. And this £79.55 that I've got this month has given me a big boost. It's given me a really good affirmation that this thing could really work. And finally, crypto, which is one of the big high risk, high reward plays at the moment. Currently, I'm in Bitcoin and Ethereum. I'm not into any other coins whatsoever. I'm not willing to take that risk because I don't know enough about them. But Bitcoin and Ethereum, I do feel like I have a reasonable knowledge of. I've never strayed from the fact, though, that the price of Bitcoin and the price of Ethereum right now is all based on human sentiment. There are barely any real fundamentals holding up these crypto coins as a store of wealth right now. But Ethereum is very much outperforming Bitcoin at the moment, with really Bitcoin not looking very healthy right now. This is all expected though. If you look at historical graphs, around this time, around 100 and something days after the halving, Bitcoin always takes a little slump like this. In fact, I'm very prepared for this to go a lot lower. These cryptocurrencies are highly volatile, but it shows that Ethereum very recently has been gaining a lot of spotlight. I think this is down to the utility use of Ethereum over Bitcoin. Bitcoin doesn't have a lot of utility. It can be used as a form of currency, but really it's going to be a store of value in the future. That's what the main opinion of Bitcoin is out there. Ethereum though, Ethereum has a very different way of using the blockchain with smart contracts. There are an unlimited amount of possibilities that Ethereum can be used for. I think people are starting to understand that. And that is why Ethereum is probably going to outpace Bitcoin right now. While Bitcoin doesn't look too healthy, Ethereum looks pretty good. With some nice big support lines to bounce off, it feels like Ethereum is extremely bullish now and it's going to continue on the long bull run. Thank you very much for watching, everyone. The investment app that I use is called Trading 212. If you wanted to get into investing, you can sign up through a link in the description below. Also, these charts that I'm using for Ethereum and Bitcoin can be found on eToro. eToro is another investment app that I use to buy and sell my cryptocurrencies. If you wanted to sign up to eToro, you can sign up through a link in the description below as well. Don't forget to check out our completely free Discord. It's a massive community of 2,000 total members. Lots of people sharing different information about loads of stocks in there. Get in there, see if you like it. If you don't like it, just leave. It's free. Thank you very much for watching, guys. And if you enjoyed this video, please feel free to like, subscribe, and invest.
I'm amazed how many people own stocks. I'm amazed how many people own stocks. The sucker's going up.